The market's been having a bit of a sell-off lately, and it brings up an important question. When do you buy the dip? How do you buy the dip? What kind of strategies can you use to enter the market? And that's what we're going to discuss here. So the first thing is dollar cost averaging. We're also going to talk about some intervals like 10 and 20%, how to buy at the 200 moving average. And the last thing, watch until the end to see this VIX 35. I think this is going to be something new for you, unless you already follow on the Discord. But watch until the end to see this VIX 35. So this is not financial advice. It's just me sharing what I've learned from more than a decade of trading. So what is dollar cost averaging? Well, it's buying at a set interval. So every week, every day, every month. And you don't worry about the price. You're just buying based on time. So whether the market's racing up or whether it's falling down, you're buying every day or every week or every month. So for example, buying $100 of the SPY, the S&P 500 ETF, and you're doing that every Friday. And if you are dollar cost averaging, I would recommend just setting it up automatically so that your broker automatically buys $100 of that stock for you every week. So you don't have to manage it. It's just automatically done for you. And you look a year later, 10 years later, and you can see your returns. So why dollar cost average when prices are high when I could just buy lower? Well, the market spends most of its time going up. You can see these strong, sudden rallies that we can get in the market. So I would answer this question by saying you don't know when the market will go down. So, look at this chart. This is the S&P 500 monthly chart. It's basically going from the bottom left of the screen to the top right. Since 2010 to 2025, 15 years, the market has quadrupled. It's gone from 1,500 to 6,000. Can you identify the COVID crash on this chart? This is it. It looks fairly inconsequential, and it was only 5 years ago. It's relatively small in this chart, and it was only 5 years ago, and it was a once in a lifetime event. You're never going to know the top or the bottom of the market. But if you're buying in a market that has this bullish bias, like the S&P 500 does, technology is always increasing, our population is still increasing, there's a bullish bias to this index. And whether you're buying near the highs or the lows, that bullish bias leads us to believe the market will be higher in the future. Most normal people with normal incomes, this is how they get rich over 40 plus years. This is how they set themselves up for retirement. Buying a little bit every week, every month, and then they look in 40 years and they say, wow, I have all this money. And that's from doing this dollar cost averaging method. So what I like about dollar cost averaging and why it's better for a lot of people is because it's systematic. It's going to prevent all of that emotion, and it's going to avoid that emotion from messing up your investments. So imagine some of the dollar cost averages, they start buying down here. And every month, then they're just adding on, whether the market's going up or it's going down. And yes, look at this. Most of the time, they're spending buying at the highs. But look a year later, 5 years later, 10 years later, and those, even with them buying at the highs, they're going to be much better off for buying at all, buying anywhere, right? Anywhere from 2010 to 2020, buying for any reason, anywhere, you'd be much better off now than if you hadn't bought. So imagine investor one, they buy up here, they're buying a pullback from this high at 5,000. But they bought with a large position. They just they dumped a lot of cash into that price. They're doing the right thing. They're getting into the market, but their position is large. And once the market dropped to 4,500, they got scared. They think, oh, a crash is coming. We're due for a crash. And then they sell at 4,500. And investor 2, they're just dollar cost averaging. They're buying even up at these highs. But then dollar cost averaging, they're also buying as the market pulls back. Then they're the ones that are rewarded when the market goes up to 6,000 and beyond. So because of this, most people would be better off dollar cost averaging or combining it with one of the following strategies. So I was talking about these intervals, 10%, 20%. These are even numbers that are just important because they're just psychological. 10%, 20%, they're big, even numbers that people just gravitate towards. If you count on your, how many fingers do you have? If you look at your fingers, you have 10. So people just pay attention to these big, even numbers like this. And when people are looking to buy on dips, they're going to be drawn to numbers like 10% and 20%. So it's going to be reasonable to buy at these numbers as well. Right? Not putting everything in at these numbers, but putting in some. You're dipping your toes in around these numbers. So it's similar to dollar cost averaging, but it's based on price instead of time. So imagine here's the high, and then the market pulls back 10% and they buy. Another 10% and they buy more. And more. And then their average price is going to be somewhere in the middle. And then once again, look a few months later, a few years later, and the market is going to be way up. If they're buying at 20% dips, they only would have bought a couple times during this. And 20% dips really are not all that common. So you don't have to be buying that often. Let's look at the 200 exponential moving average as a method of buying. That is the yellow line drawn on this chart, the 200 exponential moving average. And this is the S&P 500 weekly chart. I bring this up because market drops often find support at the weekly 200 moving average. And this is true for any market, whether it's stocks, commodities, futures, Forex. Just you can study your own charts, and you'll see this happening. Once again, I think this happens because traders, computers, investors, hedge funds, they're all looking for ways to buy the dip. And we know that the moving average acts as support. So it will, if the market's been away from the moving average for a while, then it's more likely to be support. And these sell-offs usually quickly fall down to that. And then computers catch on, traders, hedge funds, everyone catches on, and then they find this to be a reasonable place to buy. So you can see how it bounces there. Bounces here, and gets close, probably close enough to count as a test there. Looking back on the left, this is the COVID low. You can see it crashed through that, but initially there actually was quite a significant bounce at the 200. And then once it got above it, acted as support again. This is where we're at now, and I would expect that we would find support at this level again. If you want a full video on this, I made a lesson, and you have the link in the description, and you can watch that. It's about a 20-minute video, so it's a more full lesson on this. Now, what really made me want to make this video was talking about the VIX 35. So VIX tracks volatility. A higher VIX means higher volatility, and this is the chart of the VIX. You can see most of its time it spends between 10 and 20. So generally, as the market moves up, the VIX goes down. And as the market moves down, the VIX goes up. This is happening because sell-offs are usually very quick and volatile, while rallies, which is what the market spends most of the time doing, these are a bit slower, and the market, most of the time, it is doing this slow movement up. So most of the time, it is going to be between 10 and 20. But then when you have these sell-offs, that's where you see these sharp spikes up in the VIX. And I can tell you where the sell-offs are without looking at an actual chart. I can just look at the VIX, and I can say, here's a sell-off, here's a sell-off, sell-off, and then maybe more minor sell-offs through here. So on August 5th, the VIX hit 35. Now let's look at a chart and see what happened on August 5th. August 5th, 2024. So here's the chart. And here's August 5th, 2024, not 2025. And ever since then, well, at least for several months after that, the market rallied pretty strongly. So when the market found its bottom when it hit the VIX 35. Let's look at more examples. Another chart. VIX hit 35 on March 7th, 2022. And here's March 7th, 2022. We got several weeks of buying after that. Market ended up 400 points higher after it hit that VIX 35. Another example, and I'm not cherry picking anyway, I'm just chronologically going back and finding these. So hit it on January 27th, 21. Here's January 7th, 21. And we had quite a significant rally after that. So I would encourage you to go look at your own charts and study this. And this is important. I mean, clearly the computers and the hedge funds that make up most of the market, they're looking at this the VIX level around 35, and they're concluding that is a good place to start buying at. So I would definitely study your own charts and look at how you could implement that on future dips. So what's best? Well, make sure you're following what's best for you. And I know that doesn't answer it, but I think most should dollar cost average. And for those looking to be a little bit more active, then dollar cost average, but combine it with other methods like buying at the VIX of 35, buying a small amount, right? Or buying at the 200 moving average, a small amount. I think those are appropriate things to do. So thank you for watching. I have one last thing to talk about here. I've been working on this trading course for 5 or 6 months now, and it's coming time to release it. And I have the release date set as May 1st. So this course is going to have 30 plus lessons structured like this video. It's going to have the same kind of design of the slides and the same way that the charts are presented. It's going to be at least 20 hours. I haven't actually finished it yet, so I'm not sure the exact time frame, but it should be at least 20 hours. And in this, I talk about my actual setups and give you the information you need to trade like me. I don't hold anything back in this course. It's really the knowledge I have and how I trade. I'm putting it into this course. And like I said, it's going to be 20 plus hours. So that's going to be, you could watch it for a full day, a full 20, almost a full day. And anything I add to the course, we're going to make it free. So you don't have to worry about, paying more for something in the future. If you have the course, there's going to be a lot of bonus and a lot of free things are added once you already have the course. So thank you guys for watching. I hope that was a valuable lesson. I think it will be. And I showed this because we haven't seen the VIX hit 35 yet in this recent sell-off. So, it would be interesting to see if it does get to 35, and it'll be interesting to see what happens after that. I know for myself, if it hits 35, I will be adding on at that level. Thank you guys. See you next time.